Welcome to Yahoo Finance this Wednesday, September 17th, 2025. I'm Josh Lipton here with Julie Hyman. We are moments away from the Fed's decision on interest rates. Let's get a quick check on the markets ahead of that news. Stocks, let's look at the popular averages. They're mixed right now. Dow's up about 260 points. S&P 500, your broad gauge, we're down about 0.1%. And your tech-heavy NASDAQ is down about 0.4%. But Julie, the big day is here. The moment has arrived. We know what we expect. We think that the Fed's going to cut by 25 basis points. Why do we expect that? Because it appears like our central bankers are now, they're focused on the labor market. They see cooling. Central bankers, that gets on their radar because they know if the labor market goes south, it can go south in a hurry. So they're thinking, let's get ahead of that, even as we know inflation is still above target.
I haven't found a single person who thinks they're not going to cut by a quarter point today. That's because we also know that this Fed telegraphs what they're going to do. And so they have managed the market's expectations. And this is the broad expectation. Where there is a little bit of suspense is, will there be any dissents from the decision today? And we also know that the makeup in the room, the composition of the Federal Open Market Committee, there's also a little bit of drama there because we weren't sure if Lisa Cook, Fed governor, was going to be in the room because of President Trump's attempt to remove her from the committee. She has successfully fought in the courts to stay in the room, so she's there. But so is Stephen Myron, who is pretty much a direct representative of the administration. He's serving through the end of the year to fill Adriana Kugler's seat there. So he's somebody who presumably will be dovish. So, you know, once we get the minutes, that'll be quite interesting. But it will be interesting to see if there's a dissent today.
I think you're right to bring up the personalities because this is interesting in the names, the politics, the personalities. People voting here who are in the running to be the next Fed chair. Questions how that, if it all, plays into this decision making as well. The news is out, so let's get to Jennifer Schonberger with that decision.
25 basis point rate cut, the Federal Reserve lowering their benchmark interest rate by a quarter percentage point to a new range of 4 to 4.25% and signaling 2 more rate cuts this year. The decision was not unanimous. Newly minted Fed Governor Stephen Myron dissented, preferring to cut by 50 basis points instead of 25. As for the breakdown for rate projections this year, 9 officials seeing 3 rate cuts in total this year, 6 officials seeing 1 cut, 1 saw no cuts, and 1 saw 6 cuts, presumably Stephen Myron there. For next year, the median is for just 1 more rate cut. Now, these rate projections come as Fed officials upgraded their outlook for economic growth, but held their outlooks for both inflation and the unemployment rate. GDP now seen increasing to 1.6% versus the 1.4% projection back in June. And they see the economy growing at 1.8% next year. Inflation expected to remain at 3.1% this year before coming back down to 2.6% next year. The unemployment rate seen at 4.5%, which is the same estimate from back in June, and falling 0.1% next year to 4.4%. Now, officials acknowledged the weakness that we've seen in the labor market in their policy statement, saying that, quote, job gains have slowed and that the unemployment rate has edged up but remains low. That was a downgrade from back in July when they had characterized the job market as, quote, solid. One other change, they said, in considering additional adjustments to the target rate for the Fed funds rate, as opposed to the extent and timing of additional adjustments, the committee is carefully going to assess incoming data, the evolving outlook, and the balance of risks. So, guys, clearly the Fed here are concerned about weakness in the job market. Back to you.
So, Jen, now we turn to the presser. Jay Powell will be at that mic, right? You're going to be in that room, Jen, with the man himself. Let's say you get the chance to ask Jay Powell a question. What is going to be top of mind?
Top of mind is clearly they see 2 more cuts this year. So how are they viewing the job market right now? Are they concerned that there is a real deterioration, or do they see these as insurance cuts? Because if you look at their outlook, they actually see growth coming back next year. They see the unemployment rate coming down, and they see inflation coming down. So, you know, how worried are they about the job market versus inflation? Are tariffs less of a concern now than it is for the job market? I think that's point number one. From there, you know, we did hear Stephen Myron, the newly minted Fed governor, say that there are three objectives to the Fed's mandate, and one of them is moderate interest rates. We don't hear that as much because the Fed seems to sort of put that in with keeping stable prices. So I'm curious to know how the Fed is thinking about that and moderate interest rates, given that Myron is now on the committee. Of course, curious to know just what the mood was in the room. I'm not sure we're going to get much from Chair Powell on that, but it would be interesting to know with both Lisa Cook at the table after all the legal proceedings, and of course, Stephen Myron representing the administration.
All right, Jen, we'll check in with you again later. Let's get now to Jared, though, Blippery, with a look at how the market is moving on this cut. Jared.
Thank you. We've got a little bit of a bullish reaction right now. You can see the Dow Jones Industrial Average up 1% or 434 points. This is the reaction after 2 p.m. right now that we're seeing those lower rates priced into the market, and that's the Dow. Let's take a look at the NASDAQ. Well, let's try the S&P 500, and we'll come back to the NASDAQ. S&P was in slightly negative territory. Now it is up 0.2%. Not a huge move, but it is notable because a lot of times you don't see very much movement at all until 2:30, until Powell takes the lectern there. Let's see if we can get a quote on the NASDAQ, and there we go. Still in negative territory, but we did get a very similar bounce on the news from those depressed levels. And let's go on down to the bond market right now. I'm going to check out the 2-year U.S. Treasury note futures. These move inversely opposite yields, and you can see they headed up. That means yields are heading down in the 2-year, also heading down. This is up. That means the yields are heading down in the 10-year. Also taking a look at gold, very close to a record high, got a little bit higher on that, 37.27. I'm betting that is another record for gold right now. And then we'll get some sector action here. Materials flying high, up 1.64%, followed by real estate and financials. Those are interest rate sensitive sectors right there. So we're seeing those above 1%, but even consumer staples almost at 1%, then healthcare, then energy. So you got a mix of cyclicals and defensive in the leadership spot. And then tech. Tech is the only one still in the red there. I'll just pull up a quick chart there. Got a little bump off that, but not in positive territory just yet. Send it back to you.
Thank you, Jared. Appreciate it. Here with more on the Fed's rate decision now, we've got Gregory Dacco, EY chief economist, and Mira Pandit, global market strategist at JP Morgan Asset Management. Welcome to you both. Greg, as the resident economist on the panel, my friend, we will start with you. Just big picture, your reaction to the Fed decision, Greg, what do you make of it? Was it the right decision?
Well, I think it was definitely the right decision. I've been arguing for a while now that the economy is showing signs of softening. It's not falling off a cliff, but we are seeing the labor market show signs of softening. Mm-hmm. We are seeing consumers being more judicious, even though there are mixed signals in terms of the labor market, in terms of how people are spending, in terms of inflation. There is increased evidence that these tariffs, these immigration restrictions, and the policy uncertainty are restricting private sector activity. And I think the Fed is right to proceed with a risk management rate cut, acknowledging this slowdown in the labor market, acknowledging as well that inflation is still above its 2% mandate, and acknowledging that risks to the labor market are tilted to the downside. But I think one very interesting dimension here is that we're seeing this growing split in the dot plot of median rate hike expectations. You have one rate expectation which is below 3% for the end of the year. That's likely Stephen Myron's estimate. But most of the view is still that we're going to see 2 to 3 rate cuts over the course of 2025, but less easing, interestingly enough, in 2026.
So how does this comport with what we were expecting in terms of what the market was expecting? And we are seeing a little bit of a lift to stocks, for example, but not a huge move upward. That could change during the press conference. But what do you make of the dots and the implications?
25 basis points was largely expected for this meeting. Look, if the Fed had gone 50, I think the market would have been a little bit more prepared for it given what happened last year. But I would say overall, we have 3 conversations in any of these cycles, whether it's hiking or cutting. It is first the direction of travel. We know cutting is the direction we're going in. The second is around the pace. And then the third is around the endpoint. Where do we stop? Where is the terminal rate? And right now we're in that pacing conversation. So it is interesting to see that the Fed does see a little bit more cutting this year. I think that, again, that is broadly expected. But next year is such a big question mark. And it seems like what the Fed has phased out here is we want to be attentive to the risks in the labor market. When you see the massive slowdown in labor market momentum that we have seen over the last couple of months, that's an important consideration. But as we head into next year, remember that consumers will get some pretty big refunds when it comes to taxes. That will likely lift consumption and therefore growth. Corporations will also get some tax corporate sweeteners, so to speak, not necessarily cuts, but those provisions may lift profitability and lift CapEx. So we could be in a situation next year where growth has sped up, where inflation has either sped up or stayed elevated. We actually don't see it peaking until June of next year. And so that would imply that all of a sudden the Fed is go, 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 and then stop a little bit into next year. And I think that's reflected in the dots for next year.
Greg, can I get your take on the broader economy, Greg? It's noteworthy to me how I have very smart economists on the show, and I have such a range of opinions about it. I mean, there are some who flag the concerns, and you highlighted some. There are others, Greg, though, I have on who are much more confident. And I guess, if I was to sum it up, they'll talk, Greg, tax cuts and rate cuts, and they'll talk deregulation and the AI boom, and they'll say those are all tailwinds. Agree with that? Disagree with that? Give me your take.
Well, I think the one thing I'll agree on is the fact that there is very little confidence in forecasts right now. Because there are so many headwinds and tailwinds that are affecting the economy, the signals are conflicting. Whether you look at retail sales in nominal terms over the course of the past month, you would argue for a strong economy, a strong consumer spending. You peel back the inflation contribution to that, and you see that volumes for furniture, for building equipment, for groceries are falling back. So we're seeing essentially this consumer that's supporting this tension where prices are rising, labor conditions are softening. They're not falling off a cliff, but they're softening, and businesses are caught in a pinch because they're hesitant between passing on these higher costs to a consumer that is increasingly sensitive, or holding on to them, but seeing essentially a compression in margins. And that's really the trade-off that a lot of businesses are facing. This is an uncomfortable environment. It's a delicate balance. I hear a lot of people talk about the no hire, no fire labor market. That is not a sustainable balance. At one point, you're either going to see more employment or less or more firings. It's not going to be this comfortable balance when it comes to this labor market.
Mira, I want to bring you here as well. I mean, I do want to talk politics here, Mira, in the sense that, listen, there's people who are voting here who are making lists as maybe the next Fed chair. They're in the running. How, if at all, Mira, do you think that is impacting decision making?
Where I will defend Fed independence here is let's forget about everything that's happened this year and think about the dot plot and the summary of economic projections that we saw in December of last year. And in December of last year, the Fed was looking for 2 potential rate cuts in 2025. And what we are likely to see is 2 rate cuts or potentially 3 in 2025. So it's really in line with what they were saying months ago, in that there was an anticipation that the economy would soften relative to the last few years. Now, tariffs certainly threw them for a loop, and they have acknowledged that, look, if it weren't for tariffs and if it weren't for potential higher inflation coming along the way, that they would already be cutting. And typically, the Fed actually does tend to cut before they get all the way down to their inflation target. With 3 meetings and now 2 meetings left in the year, it's not unrealistic and unreasonable what they have chosen to do, especially when it's supported by the weaker labor market data that we've seen. So it is a committee. You do see with the dissents, there could have been a lot more dissents than we actually ended up seeing. So that consensus building still does appear to be at play underneath the surface.
With one exception.
Sure.
Right. So I want to talk about the exception a little bit. Stephen Myron saying we should have cut a half point. Is there a legitimate argument to be made for having cut a half point today? Or does this emphasize that he is exclusively a mouthpiece of this administration that very clearly wants a cut for its own purposes?
I mean, I think you've heard me argue the rationale that we're going to see tariffs affect inflation, affect prices, but it's likely to be a one-time hit because the labor market is softer than it was back in 21, 22, where you had this wage inflation spiral. You're not going to get that in this environment. Wage growth is actually decelerating. Employers are not looking to raise wages, they're looking to cut costs and cut employment. So you're not necessarily seeing that potential for a second round effect on the wage front. So I think the pass-through from tariffs is likely to be a one-time shock. We still have some disinflationary currents in the housing segment, for instance. So there is room for the Fed to be easing, to be buffering this negative shock to the labor market. I would have argued that you can actually ease monetary policy and bring it back closer to neutral over the near future. So I wouldn't have been opposed to a 50 basis point rate cut. What I found surprising is that Governor Waller and Governor Bauman did not dissent. They were in favor of of this 25 basis point risk management rate cut. This was in the statement. Essentially, in light of the growing downside risk to the labor market, we're going to be cutting 25 basis points, and we're going to keep adjusting monetary policy as needed, as the data shows and as the data reveals how strong or how weak the economy is. And that's, I think, where the market pricing is perhaps getting a little bit ahead of itself. We're not necessarily going to be in an environment where the Fed's going to be cutting at every single meeting, regardless of the economy. A lot of attention will be paid to inflation and to the next payroll report.
Greg, Mira, that was great. Stick with us. We're going to see you after Chair Powell's news conference, but we've got more reaction to the Fed's rate cut that is coming straight ahead. Stick with us. The Fed cutting interest rates by 25 basis points just moments ago. For more on how this impacts the bond market, we're bringing in Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, it is great to see you. I'll start just with that news. Kathy, the Fed's decision, what do you make of it?
Well, I think the 25 basis points was pretty much in line with expectations. Opening the door to 2 more rate cuts this year does indicate that the Fed is very concerned about the labor market. And so that's somewhat bullish relative to, say, some expectations. But in general, I think the statement tells you that they're nervous about the labor market. They have some catching up to do, and they intend to do it in the next couple of meetings. I think what's really interesting is the wide dispersion of dots this year from, someone who actually didn't want to cut it all to somebody who wants to cut a whole bunch this year. So I don't know when I've seen that wide a range from 4.38 to 2.88 in the projected Fed funds over a short period of time. So clearly a lot of dynamics under the surface there at the Fed.
Kathy, it's Julie here. Given the outlook for the Fed, we have seen bond yields come pretty dramatically down over the past month or so. And I wonder, given now that dispersion of dots and what happens after today's meeting, what you think is priced in to yields across the curve, and what do you think happens from here?
Yeah, going into this, the market had discounted a lot of rate cuts over the next 15 months or so, getting Fed funds down below 3%. I think that's probably going to be reinforced today because of the signal that there are 3 rate cuts, including today, this year. I think the problem that we're going to face as you go out the curve, though, and you look at intermediate or longer term yields, is that inflation is still high and the Fed actually doesn't see it coming down all that much. So they've got unemployment kind of staying around this level, inflation edging a little bit higher for the next year or so, and GDP growth edging a little bit higher from where we are. And it's kind of an inconsistent message to have, and that I think can give you a lot of volatility going forward as you move out the curve, 10 years. And so we're going to see probably a lot of movement there as the market adjusts every data point.
So Kathy, let me ask you, for fixed income investors that are listening right now, Kathy, post this decision, what advice would you give them?
So we've liked staying in high quality bonds in the intermediate part of the yield curve since late last year. And that intermediate is probably the 5 to 7, 5 to 10 year area as an average duration. So if you're just too short duration, you're going to have reinvestment risk as the Fed lowers rates. If you're too long, you have the risk that either inflation doesn't behave as anticipated, or you get a lot of volatility around all these sort of political events and economic events that can have an adverse effect on inflation. So sticking in the middle gives you a chance to earn very nice returns with less volatility than we're anticipating in other parts of the yield curve. It's a good environment for bond investors. You're still looking at clipping a nice coupon, probably getting some positive total return from price appreciation. So it's still a good environment, just not go too long or too short.
Well, and on the too short side, obviously we saw a lot of people get into cash over the past couple of years with yields on things like CDs where they've been. Has that rotation out started? Do you think if people need to do it now if they haven't already?
Yeah, I think if you're heavily in cash right now and it's more than you would normally have in your allocation, then there's still time. You're still looking at decent yields, and I would do that because the Fed is cutting rates. So as those rates come down, you're going to reinvest at much lower rates. So if you want to maintain the same level of income, you have to move a little bit further out in maturity.
All right, thank you, Kathy. Great seeing you.
Thanks.
Joining us now for a closer look at the delicate balance of risks the Fed is facing, we have Loretta Mester, senior scholar at Princeton University and former president and CEO of the Federal Reserve Bank of Cleveland. Loretta, it's great to see you. We were just talking to Kathy Jones about the dispersion of dots, and we also know, just because of sort of the drama in the days leading up to this Fed meeting, we know about the dispersion perhaps of personalities and views inside the Fed chamber has been sort of widening. How should investors be thinking about that and how they can reach consensus? I mean, not today, they've reached it, but for the remainder of meetings this year.
Well, the first thing to point out is there's a reason for dispersion that's independent of the personalities in the room. And it really has to do with there's cross currents in the economy. And some of the things that we're seeing are due to reactions of firms to higher tariffs that are either in place already or coming. Some of it has to do with the labor market and the fact that the supply of labor is moving as well as the demand of labor. So there's a good reason with so many cross currents on the economy that you'd expect to see policymakers doing their job and really perhaps coming with different data, different views of the data, different reconnaissance from their districts, and maybe having a different opinion about what is the best policy to get back to full employment, maximum employment, and price stability. And so that's showing up here. And that's not a problem because that's the type of dispersion in views that one might expect given the uncertainty about where the outlook is going. They did reach more or less consensus. There was only one dissent. I know some people were thinking that we might see more this time. So, it looks like they had a good discussion around the table about the economics, the outlook, and really this is a risk management process here, right? We know the downside risks to the employment part of the mandate have gone up with the data that shows that employment is weakened. We're not necessarily saying the employment picture is bleak because supply and demand are really still in balance, although, it's like I call it an uneasy balance because demand could begin to pull back more than so far, but the unemployment rate remains low. So again, the inflation numbers, the committee has said, many members, that they think they're going to look through that in terms of it's a one-of, but others are more cautious, and you can see that in their projections. As I think someone on your panel before, the dots really speak to the different narratives that could really explain this economy. Some are saying that we do have an inflation issue independently even of the tariffs because core services X housing is not moving down on a path back to 2%. It seems to be quite sticky. And I think you see that in the dots with people reluctant to do more cutting. And others are probably putting more weight on the employment picture and looking at that picture and saying downside risks are starting to manifest themselves, and so they should take out more insurance and therefore cut more. So I don't see this as a problem or even anything that's really surprising, that given the environment we're in, that you'd see this kind of dispersion. And the chair did a great job, I think, in bringing the parties to the table and getting a consensus. And we'll hear more in the press conference about what that meeting, how they determined where they went to and what kind of balance of risk they're looking at.
Loretta, you mentioned personalities there, and there's a lot going on there, Loretta, in terms of the personalities. You got a lot of drama with Lisa Cook and Stephen Myron, and I'm just wondering, Loretta, how you're thinking through all that. If you were still at the Fed, how you would be navigating all that, Loretta, these personnel issues.
Look, I don't know Steve Myron, but I know the other people around that table. And I can tell you that all that is left outside the room. When you go into the room, you're there to do your job, which is analyze the economy, bring your best judgment to bear, look at the models, hear what the staff says, hear what your colleagues around the table are seeing in their districts and how they're interpreting the data and the economic developments that we've seen since last meeting, and then coming up with a path forward into what's going to get us back to price stability and maximum employment. So all of that stuff may be, thought about when you're out of that room. But once you're in that room, you have a job to do. And the people I know at the Fed take it very seriously. They're very dedicated to the mission of the Fed and hitting the congressionally mandated goals. And that's what they do in that room.
So in that room, as they make those earnest arguments, I'm going to ask you a similar question, what I asked an economist earlier, which is, do you think there is a valid argument for a half-point cut to have been made today, as Myron presumably made?
Well, I don't know what Myron said in the meeting, so set that aside. But yeah, I think there could be a credible case. Certainly not what I would support, but the case would be, we saw the weakening, starting at the earlier meeting, the July meeting. There's some who wanted to cut at that meeting. So let's go back to the data came in and confirmed the weakness in the labor market. So let's make up for that, perhaps a bit late start and do 2 now, and perhaps then do a couple more this year. So the data are coming in. It's really how you're balancing the risks. Some are going to see the labor market demand side of the labor market justifying a cut, but others could read the labor market as saying, well, we shouldn't expect to see the 150,000 per month job pace that we used to see because the supply of labor is also moving down. And so, estimates of the break-even rate, i.e. the rate of job growth that's going to keep the unemployment rate constant, is now, about 50,000 to 60,000 per month, not the 100 to 150 that we used to have. And so part of the calculus here is this really a strong weakening in the labor market, that could pick up and therefore we need more insurance cuts, or is this really the labor market stabilizing at a lower level of job growth? And we don't know that yet. We need to see more as the economy evolves. And so, I think I'm hoping that the chair doesn't necessarily lean in one way or the other. I think this is a case where it's an evolving economy. You have to analyze going forward. And, they're poised, if they need to cut more because the labor market's deteriorating more than they expect, they're in a position to do it. And if inflation turns out to be continuing to be sticky, they need to keep policy somewhat restrictive. And I think the 25 basis point today still maintains some restrictiveness in policy, although they differ in how much they view that restrictiveness. Some would probably say, okay, 1, and now we're at neutral and do no more because inflation's still elevated. Others would say there's still room to cut and still be restrictive on policy. So again, that's another difference of opinion, and they'll have to see how the economy evolves to make their decisions at meeting by meeting going forward.
Loretta, on Myron being the only dissent, the rest of the Fed stuck together. Did that surprise you at all, Loretta? There were some who would assume maybe you'd actually see more than one dissent here.
I didn't know, obviously, but again, a 25 versus a 50 is not that different in terms of the impact on the economy. And I know that some wanted to cut last meeting and there were 2 dissents there, but again, their policies moving in the direction that they thought was appropriate. And that doesn't seem to warrant, a dissent in my view, because you got what you were asking for, which was reducing the degree of restrictiveness. And so I think that, you can, I always went into these meetings saying, okay, here's my view. I'm going to hear what people around the table say. But if you're getting policy moving in a direction that you can support, it's less important that it be a 25 to my mind or a 50. It really has to do with, okay, where do people see things going? And as you see in the dot plot, there's some that in all of them, the median path is coming down over time. We don't know exactly the timing of it.
Hey, Loretta, we do have to end it there with Jay Powell stepping up to the mic. Thank you. That was Fed Chair Jerome Powell. For more on his comments and the Fed's decision to lower its benchmark rate, we have EY's Greg Dacco and JP Morgan Asset Management's Mira Pandit still with us. Thank you both for being here. Greg, I'll start with you. Presser concludes. I know you were listening carefully. You were taking notes, Greg, student that you are. What were your big takeaways?
I think there were three takeaways and a slightly hawkish tilt to the overall press conference. Number one, Powell did confirm that this was a risk management rate cut. Number two, he did highlight that they were going to proceed on a meeting-by-meeting basis. There's no guarantee that there's going to be a rate cut at every single meeting going forward. And number three, he confirmed that essentially the economy still warrants a moderately restrictive monetary policy stance. Those three elements are more hawkish than the rate cut and that the statement might have indicated. So the Fed is still on this gradual approach in terms of monitoring economic data, inflation data, and adjusting monetary policy as it sees fit, depending on the economic outlook.
Were there any questions, Greg, I'm just curious, that weren't asked in that presser by those very good reporters that you wish had been?
No, I think one thing that I'll highlight that was, I think, very important is that Powell iterated twice that there's no risk-free path. Essentially, we have a large dispersion of views when it comes to the dot plot, with some actually expecting a rate hike before the end of the year, and some expecting, Moran likely, expecting 150 basis points of rate cuts. So we have a wide dispersion, and Fed Chair Powell highlighted that dispersion and mentioned the importance of looking at this from a probabilistic perspective. There are 10 policymakers that foresee 3 or more rate cuts. There are 9 that foresee 2 or less. So there's a wide degree of dispersion, and it's a historically challenging economic environment to navigate monetary policy.
Mira, I want to get your thoughts as well as the strategists you were listening. What were your highlights, Mira, and what do you make of the market's response and reaction?
One of the things I would add to Greg's comments is when he was talking about the balance of risks, Chair Powell, he talked about how that balance of risks were skewed towards inflation, and not that now they're skewed towards the labor market, but they're potentially approaching equilibrium. So his sentiment in that hawkish vein was that the inflation picture is still very much squarely on their minds. The labor market component has started to balance those risks out a little bit more, but we're not squarely balanced, and they're certainly not all the way swinging towards being so worried about the labor market at this juncture yet. Now, I'd also say, again, they do have a very challenging situation ahead of them in that you could see growth slow the rest of this year, then start to pick up early next year and slow again. You could see inflation lift, stay high, and then start to peter out next year. And all the while, some of the things that might lift growth may not also make the labor market stronger. If you have things like corporate tax provisions where people can spend more on CapEx, maybe they have a little bit more cash on hand, perhaps that could prevent them from having to lay off as many people if that was the direction of travel. But it's not necessarily going to reinvigorate the labor market. So it's interesting to hear from them that while inflation may be the transitory bit and usually the labor market is not, that's not really reflected in how they've put out their summary of economic projections, with inflation numbers going up, but also the unemployment rate going just a tick lower next year for their 2026 projection. And I think that highlights the challenge of looking at these things in aggregate, trying to decide who the dots are, trying to decide how the chips really fall when you look at that summary of economic projections in these two distinct camps.
Mira, did you see or hear anything today that changed how you want your clients positioned in the market?
I think it's important in the vein of some of Greg's comments about how it was a more hawkish meeting and that this is an insurance cut. We're not quite at the point where we're worried about recession, that we have to think about how the yield curve reacts typically when we do see recessionary versus non-recessionary cuts. So I would expect that in a cutting cycle, you probably will continue to see short-end yields fall a bit more. But as you move further out in the curve, we could continue to see yield curve steepening, especially when you think further out on the yield curve, things like Fed credibility to manage this economic situation under question. Fed independence is clearly a common question that came up in the presser.
The very first one.
The very first one. You think about the state of our federal finances and the supply that potentially could be coming to market. The balance sheet was also a question, and that quantitative tightening seems to be continuing on a set course. So you have a number of different things that are potentially going to result in yields, which have dropped more recently in response to some of this labor market data, actually start to drift higher. I think that's an important point for clients to remember as we're seeing some of these moves, particularly on the yield side.
Greg, let's say you're out and about and you meet somebody, maybe they're not even invested in the market, and they just asked you, Greg, as an economist, all right, I heard the Fed made a move, they made a cut, they cut by 25, and they asked you to explain, Greg, just what impact that has on them and their family. How would you walk them through that?
I think Mira is absolutely correct that long-term rates matter a great deal. And Fed Chair Powell acknowledged that. He mentioned that the path, the trajectory, or the expected trajectory of the Fed funds rate matters really a great deal for consumers and for businesses. Because let's not forget, a lot of people borrow on long-term rates. If you're buying a house, what matters is long-term rates. If you're buying a car, usually it's medium-term rates. So those are the rates that influence private sector activity. Whether it's a consumer or the CEO of a large firm, they're going to be highly dependent on these longer term rates. And that is a conundrum for the Fed, because if markets anticipate that there will be a lift up in longer term rates because of the fiscal trajectory, because of a question around Fed credibility and Fed independence, because of a number of uncertainties with regards to the policy trajectory, then you could have much less stimulus to the economy. And so that person in the street that's asking me, what does this do? It doesn't do a great deal in terms of supporting the economy. You'd actually need to be moving much closer to neutral to actually see a more significant buffer in terms of the downside risk to the labor market that Fed Chair Powell was highlighting.
On that subject of Fed independence, Greg, first question out of the gate, and Powell simply said, listen, we're committed to maintaining our independence. Beyond that, he didn't have anything to share. Listen, it is a topic that's raised. I'm curious to get your take. Is there something there? Do you think that's just political and posturing? What do you make of it?
Well, I think there's certainly a lot of noise around Governor Cook, around Moran's appointment and confirmation just before this meeting. So there is going to be this perception of an influence, especially with Moran keeping both roles as the CA chair on a leave of absence and now as a governor, at least for the next 3 months. So there is going to be that perception of influence on the Fed. The thing that is important to remember, and you were saying that just earlier, is that this is not a one-person vote. This is not a one-person decision. This is a committee that votes on the trajectory of monetary policy. And yes, there may be influence. We're seeing that in the dot plot. But that does not mean that the Fed is all of a sudden going to turn entirely political. It's still apolitical. As Loretta Meister was saying just before us, we still have a number of policymakers that go into this room, disregard any political views, and essentially try to do what's best for the economy, what's best for price stability and maximum employment.
Greg, Mira, it was great having you both here today. Appreciate that analysis. Thank you.
Thank you.
Well, the market making some interesting moves as Fed Chair Jerome Powell spoke after the Fed cut rates. Jared Blickery is here with a look at the action. Jared.
All right, let's break it down. We have a mixed market here, and I'm going to show you the Dow first. We began with a move up. This is what happened at 2 p.m. Powell, he took some questions. Market went down a bit, dipped slightly into negative territory, but guess what? It is right back where we were when we started. So net didn't really happen. Not really much happened today. Nevertheless, it is up 278 points. Then here's the NASDAQ composite. It's trying to get green here, not able to just yet. So a little bit more bullish actually on the NASDAQ because it is net up from that 2 p.m. report time. And then the S&P 500 just barely in positive territory. And you can see some zigs and zags here, but the lows were firmly rejected. So I think the hawkish cut is kind of the theme of the day here. Meanwhile, here's a Russell 2000, a little bit off of that 2 p.m. level, dipped into negative territory, but still holding on to gains of about 1/3%. And I think what's happening in the bond market is really fascinating. You know, you go back a year to September of last year, that's when the Fed started cutting the first time. And long-term interest rates, they went up. They went the opposite direction. That's what mortgages are tied to. And I think that caught a lot of people off guard. Look what's happening today. The 10-year is up 4.0 to 4.08%. That is a move of 5 basis points. That is significant, even farther off of those lows there. Very similar story for the 30-year. That is up a net 3 basis points and probably traveling about 6 or 7 basis points off that low. Meanwhile, the U.S. dollar index firmly rejected a multi-year, I believe it's a 3-year low that we're looking at right there, and is back up in positive territory. So that is a bullish setup for the US dollar index. And I would note that the street and most investors have been pretty bearish on the dollar. So watch out for a potential pain point right there. Just checking in on the sector action. Financials are in the lead here. They're up almost 1%. And then you have a little bit of a defensive setup. We got staples and utilities each up almost 0.5%. Materials on the second row, barely holding on to gains, 15 basis points, had been the leader coming into the meeting, not so right now. And then industrials, tech, consumer discretionary, those are your 3 losers. I'm going to leave us with a look at the NASDAQ 100. You're going to notice some more red than green, especially among the mega caps right there. Nvidia down 2%, Broadcom down 3%, but Tesla up again. It's been on a nice streak there. That is up 1.15%. Back to you.
All right, Jared, thank you. Let's go now to our Fed correspondent, Jennifer Schonberger, who was in the room for Fed Chair Powell's remarks. Jen.
Hey there, Josh. Fed Chair Jay Powell clearly saying that the balance of risks have shifted more towards the labor market, noting that the drop in supply of workers and drop in demand for workers has really caught Fed officials' attention. He noted that it was really those downside risks to the labor market that drove today's cut. He referred to it as a risk management cut. Take a listen.
I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off.
Now, Powell said the Fed is going to take these rate cuts meeting by meeting, even though 2 more cuts have been penciled in by the median. He again said, look, you should look at the SEP and the dot plot, which is the interest rate projection that each member of the FOMC pencils in, as sort of is not set in stone, so it could change. So again, kind of taking this meeting by meeting based on the data. As far as inflation, Fed Chair Jay Powell noted that they still see any impact from tariffs as a one-time increase in prices, but that they will change course if they feel that inflation is going to be turning persistent. Now, he was also peppered with questions on Fed independence, particularly the fact that newly minted Fed Governor Stephen Myron is still retaining his post at the White House. Chair Powell saying that we're strongly committed to maintaining independence. Beyond that, he had nothing to say. But he did have this to say on Fed independence and the decisions that Fed officials make.
It's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just, everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes.
And Chair Powell again talking about the impact of immigration on the labor market, the fact that that is putting downward pressure on the supply of workers, as we're also seeing demand for workers drop. And it is probably the reason why Fed officials have penciled in 3 cuts, so 2 more remaining cuts this year, which is why they see growth continuing to continue through this year and rebound into next year. It seems to be the case that these cuts that they've put in place is what is going to keep the economy humming going forward. Josh?
All right, great stuff as always. Thank you, Jen. Well, that concludes our Fed Day coverage. Market domination begins right on the other side. Welcome back. It's time for Market Domination. I'm Josh Lipton, live from our NYC headquarters. We've been locked in, of course, on the Federal Reserve September decision to cut interest rates by a quarter point. Right now, we're under an hour away here from the closing bell, and stocks mixed heading into the close. The Dow's up about 265 points. The broad gauge, the S&P 500 is basically flat. The Nasdaq is down about 0.2%. Meanwhile, Nvidia caught in the trade crosshairs between the U.S. and China. That stock is under some pressure after Chinese regulators reportedly barred the country's biggest tech firms from buying AI chips from Nvidia, a move underscoring Beijing's push to build up its own semiconductor industry. Nvidia CEO Jensen Huang saying he was disappointed with the situation. Rhodium Group Director Riva Gujan joins me now. Riva, always great to see you. So this is the FT, Riva, saying China banning its companies from buying some of Nvidia's chips. Looking at Nvidia here, we're down a bit. We're down about 2.5%. What do you make of that report, Riva? Why is China doing this?
A large part of it is signaling, Josh. We're in a very experimental phase of U.S.-China negotiations, as you can see from the Trump-Xi talks that are expected on Friday. Besant in Madrid talking to his Chinese counterparts, trying to drum up some sort of compromise, some kind of bargain deal. And amidst all this, when we're talking about potentially maybe lowering tariffs in some areas, purchase agreements, things like that, the TikTok deal as well, you have a lot of escalatory points happening on the tech controls front. And China is trying to use this broader negotiating climate to basically see what it can get out of the U.S. at this stage, especially in trying to test Trump's transactionalism. So for now, there's a careful balancing act with Beijing in trying to ensure that Chinese AI developers understand that ultimately it's going to be Beijing to steer local adoption of homegrown chips on its terms. And so I think this is part of that signaling effort, but also use that with the United States to say, look, we're not really satisfied by lower grade chips. We're going to go for the most advanced chips possible.
Let me ask you, if that's China's tactic, if that's the strategy here, kind of throw some weight around, signal, hey, we got leverage in this trade fight as well. Did you think it works, Riva? Do you think that tactic is going to prove successful?
I think so. I mean, because on the one hand, you want to tell Chinese AI developers, look, don't go on a big shopping spree for Nvidia chips, right? So this undermines the Nvidia and the U.S. addiction assumption that it can create these bigger and bigger Chinese dependencies on the U.S. technology stack. But at the same time, China is playing several different moves in all of this. It wants to really maximize concessions from the White House at this stage. And it's not just about the GPU sales. Certainly that's going to help when it comes to talk of purchase agreements with the U.S. So on that list, that kind of grocery list of things that the U.S. is going to be demanding from China to include agricultural goods and Boeing jets, GPUs are a nice high value item, right, that you want to put on that list. And so naturally, China wants to go for things like the Blackwell chips that Nvidia is designing for the China market. But beyond that, China wants to go for more here. And that's where it gets into the more foundational controls. And so one of China's biggest choke points still is on high bandwidth memory chips. And so if China can get the US to ease on that, that would be a big win. If China can get the U.S. to ease up on semiconductor manufacturing equipment controls, that would be a big win. To be clear, I don't think that the U.S. is going to go there because those foundational controls are critical for companies like Nvidia to ensure that they stay well ahead of emerging competitors like Huawei.
Riva, I guess if I was an Nvidia investor today, I would be wondering, listen, bottom line, what is this company's long-term real opportunity in China? Like, how much money really can CEO Jensen Huang actually long-term make over there? Do you think we can say with any real definitivity here what that would be? Do we have clear line of sight or no?
I don't think even Jensen has that clear line of sight at this point, but it all comes down to the timeline here, right? So when we look at Chinese indigenous chip production. We're, I think, about to see the US administration upgrade their estimates of Chinese chip capacity. They had extremely low estimates from the Biden era. Those are now about to be revised. And so that's what's also driving this urgency to say, look, if Huawei and other companies are able to produce at comparable levels, then let us into the market. So the question now is, if the US allows more advanced chip sales into China, how long does that last? And to what degree does Beijing use this as a bridge toward its own self-sufficiency? Because right now, back to the Chinese chip capacity point, while they are building capacity in pretty significant ways here, it's not enough to satisfy domestic demand. Right. And so, having access to more advanced chips, Beijing's ability to steer that, and China has no shortage of state planners to do this. It's all about kind of like a delicate balancing act here of crafting that pathway, that timeline. So for NVIDIA's perspective and for investors' perspective, it's really all about how long does that timeline last? And that question is directly related to the estimates on Chinese chip capacity and how fast can they ramp up, especially if the US-led export control regime has significant holes in it, especially when it comes to the tools and the servicing of those tools, the HBM factor, everything like that.
I only have 30 seconds left, Riva, but besides NVIDIA, what other American companies are or could be in Beijing's sights?
Well, this was a big week for Chinese retaliation. So they launched two really big investigations, an anti-dumping investigation that's going after analog chip makers. So think Texas Instruments, Broadcom, onsemi, those are in sights. You have an ongoing SAMR probe and an anti-monopoly probe on NVIDIA. Google also has a SAMR probe. Intel is likely a very big target as well, but China's probably just waiting for the right moment for that because it's such a huge political symbolic target, especially with the USG having a direct stake in the company.
Riva, always good to see you. Thank you so much for your time. Appreciate it.
Thank you.
Up next, Tesla shares hit with a downgrade this week. The analyst behind that call, straight ahead. CFRA downgrading Tesla from hold to sell. The analyst saying that the stock's valuation has become detached from fundamentals. Joining me now is the author of that note, CFRA analyst Garrett Nelson. Garrett, it is great to see you. So you go to a sell on Tesla, Garrett. You are betting against Elon Musk. Walk us through why.
Sure. Thanks for having me. This really follows a growing disconnect between the performance of the stock since it bottomed in April. The Tesla shares are up more than 85%. Combined with looking out over the next several quarters at where street estimates are, we think they're still too high, and they're not fully. We don't think analysts are fully incorporating the negative impacts of the One Big Beautiful Bill that was signed into law in early July. Specifically, the impact on Tesla's bottom line from the emissions trading credits going away, which has been a huge earnings growth driver for Tesla in recent years. It was about $2.8 billion of revenue. That was up 54% year over year last year. And basically, there's no cost associated with that revenue. So it all has flowed down to the bottom line. So we look out at estimates for the third quarter, looking out through the end of next year, and we think estimates are still too high and subject to downward revision.
That is an issue, Garrett, though. I mean, it has been discussed a lot, including on this show. You simply don't believe that's reflected in consensus?
No, based on our work, it's not. And, so you have estimates that are too high. You have a valuation that appears very frothy. I mean, it's trading at over 200 times our earnings estimate for next year. And so, based on those multiples, this is a stock that's had several 40% plus pullbacks over the last several years from peak to trough. And we think, this is another one of those setups.
When I have bulls on the show, Garrett, in part, and I ask them why they're constructive on the name still, they'll talk about the core EV business, which still does drive the P&L here, and the new affordable model on the way. And they're clearly confident that's going to be a growth driver. I'm curious to get your perspective on that.
we're still constructive on the story longer term. So to be clear, this is more of a 12-month call. That's what we base our price targets on. And so our 12-month price target is $300. And I think we're seeing all the red flags that would suggest a pullback is coming here. But longer term, we like the fact that they're in the sort of the industries of the future, autonomous driving, increasingly in robotics. There's a lot of reasons to be bullish on the stock looking out 5 to 10 years from now. It's just that the near term, I think, analysts have really overestimated the earnings, and there's a lack of understanding just how much of an adverse impact that law is going to have on Tesla's bottom line, starting with the third quarter.
Can I ask you about autonomous and AI, which you brought up there? Dan Ives over at Wedbush. Now, he, of course, bull of bulls on the name, right? He told his clients, Garrett, Tesla is in pole position to be a clear leader in the autonomous market opportunity, robotaxis. He says set to scale to 30 to 35 cities in the U.S. over the next year. Says we believe the AI future at Tesla is worth $1 trillion to the valuation alone over the next few years. What is your response to Mr. Ives there? You agree with that?
No, I mean, look, there's a lot of reasons for optimism there. In our view, though, their full self-driving, where it is today, is not ready for prime time. They're only in Austin in the Bay Area right now. And you can go online, find any number of videos that have been uploaded in recent weeks where the software is taking a vehicle the wrong way into oncoming traffic. It's just not quite ready for prime time. And so I think Tesla is going to continue to be careful about rolling this out to other markets until it's proven that it is safe and it is ready for mass adoption. But the other thing I would say is that on Tesla's last earnings call in July, Elon Musk acknowledged the possibility of a rough few quarters ahead for the company. We think investors should take him at his word.
What about the pay package, Garrett, for Mr. Musk? The $1 trillion man, potentially. I'm curious, as an analyst covering the name, what you made of that. Did that remove kind of one key risk, Garrett, that folks did talk about, that Mr. Musk might leave Tesla?
Yeah, it does. And we would expect, we do think shareholders will approve that pay package at the annual meeting in November. What we've seen over time continuously is that shareholders have shown support for Musk. Obviously, he's delivered for them over time. If you've been a long-term shareholder, you've done very well. And so, and we also like the fact that it really aligns Musk's interests with the interests of shareholders. He doesn't even meet the first tranche under this new pay package proposal until the stock essentially doubles in price from where it is today. So the goals are very lofty for this pay package, as they were back in 2018, and in fact, he succeeded in meeting every one of those thresholds.
He did indeed. Garrett, thanks so much for your time today. Appreciate it.
Thank you.
While we're wrapping up today's Market Domination, don't go anywhere. After the closing bell, the earnings fund begins. Stay tuned for Market Domination Overtime.